Hello and welcome back to my morning note. It's very good to be back after far too long away. Now, we're past the cliff. What about the ceiling? It's only a few weeks since we had the great excitement over the fiscal cliff, the combination of automatic tax rises and spending cuts that was due to take place at the beginning of the year. But in fact, the deal that was reached over the cliff really only pushed the issue forward for another 2 months. That is when the spending cuts will be discussed once more, and that will coincide with another opportunity for Republicans in Congress to force a default by the US, should they wish to do so, by refusing to raise the US official debt ceiling. On paper, that would appear to be a much more dangerous situation than we had in the cliff, and yet you certainly wouldn't think that from the way the markets are behaving at present. Is this a case of irrational equanimity? With me now to discuss this is our US markets correspondent, Stephen Foley.
Great to be here.
Good to see you in London for a change. Let's start by taking a look at the VIX index, measure of volatility or fear in the markets, produced by the Chicago Board Options Exchange. This would appear to suggest that there is nothing to worry about whatever. What are we missing here?
It would suggest that, doesn't it? I mean, maybe you could look at renaming the CBOE as the complacency born of experience, because what we've had is repeated crises where Congress takes us up to a critical deadline and then pulls back from the brink.
Right.
But I think what we have coming up in the debt ceiling, which coincides with, as you say, the sequester, the massive spending cuts that have been pushed into the next round of discussions. Also, at the same time, a continuing budget resolution, so the funding of government runs out at the same time as well. So there's three big things that coincide in just a few weeks' time, and as you know, the cliff, the prospect of a default on US debt. That's a more serious prospect than taxes going up for a few days before Congress gets round to lowering them again.
Okay, let's take a look at previous instances where Congress has had an ugly surprise for the markets. The red line is the last time there was a set to over the debt ceiling, and in the middle of that period, the end of July 2011, you can see that there was a huge transfer from stocks into bonds, even though it was bonds that were being called into question. The blue line is in the 2 months after Lehman, and you can see things take off after Congress very startlingly decided it was originally going to vote down the TARP plan to bail out the banks. Doesn't that suggest that there really is a very big risk of a trapdoor coming up?
I think the fiscal cliff has lulled us into this sense of complacency. What these charts show is that congressional tactics do have real market consequences, and big ones too.
And in both these cases, they actually did pull back from the brink. They did raise the debt ceiling, and they did allow the TARP only a few days later. But the damage evidently was done. The
damage is done, and it takes a long time to repair. The US was downgraded by S&P in the wake of the debacle last time. Obviously, we lost critical days with the banking system, which made the recession deeper in 2008 as well. So these do have consequences, and the trouble with the complacency, the trouble with this pattern emerging of Congress always going up to the brink and everyone expecting them to pull back, is that they have to go nearer to the brink each time to get the same sense of galvanization in Congress.
And also markets need to scream ever louder each time to force Congress into doing something. Now, there are various possibilities that people have been discussing really quite widely now for getting out of this. One is the notion of just invoking the 14th Amendment, which makes it impossible to impugn the credit of the United States and just say, sorry, Congress, you can't do this. Another is the notion that the Treasury could just mint one coin made out of platinum that's worth $1 trillion. Are these really ways out of this?
I'm afraid they're not. I mean, they're very seductive ideas and great fun. Lots of great jokes about Obama or Jack Lew, the new Treasury Secretary, hopefully losing the coin down the back of a sofa or something like this. I mean, the trouble with both of these is they're open to challenge. They would almost certainly be challenged through the courts by either by congressmen or other groups. Timothy Geithner, as Treasury Secretary, has always been very fond of suggesting that the 14th Amendment can be used to just justify sailing on past the debt ceiling. I think the very fact that there would be a constitutional challenge to it means that I'm not sure anyone would actually want to buy...
We'd end up waiting for a Supreme Court ruling rather than...
And I'm not sure any investor is actually going to buy government debt on the day after the debt ceiling, worried that maybe the debt that they're buying is unconstitutional and might be cancelled.
Thank you, Stephen. I think we do have a fairly clear conclusion here. Disaster is certainly not guaranteed, but there's far too great a risk of disaster at this point for people to be quite as complacent as they are.